With the Federal Reserve finally starting to lower interest rates, a lot of capital is getting ready to move. Every financial news channel is talking about rate cuts, but almost none are telling you where the money is actually going. If you're just starting to build your portfolio, this moment can feel more like a threat than an opportunity. You're hit with a flood of confusing advice and a nagging fear of making the wrong move, or worse, doing nothing at all. But what if you had a clear roadmap? What if you knew about a specific class of investments positioned to thrive in this new economic chapter? In the next few minutes, I'm going to cut through the noise and show you 3 powerful, high-yield REITs set to benefit massively from the Fed's recent moves. These are companies at the heart of the biggest economic revolutions of our time, from the engine of e-commerce to the physical backbone of the AI boom. One of these REITs benefits more from rate cuts than the others, and most investors completely misjudge which one it is. All right, let's get into it. First, let's quickly break down why these rate cuts matter for our strategy. Think of the Fed's interest rate as the cost of money. When rates fall, it's like putting money on sale. Now imagine you're a real estate investment trust or a REIT. Your business is built on buying and managing massive properties. Think gigantic warehouses or towering data centers. When interest rates fall, a REIT's borrowing costs go down. It becomes cheaper to refinance old debt, buy new properties, and fund huge development projects. This translates directly to higher profits. And because REITs are legally required to pay out at least 90% of their taxable income to shareholders, those higher profits often lead to bigger dividend checks. It's a simple, powerful formula. Lower rates equals lower costs equals higher profits equals higher dividends. But here's the key part that most people miss. Not all REITs are created equal. A rate cut might be a gentle breeze for a struggling mall REIT, but it's a powerful tailwind for REITs in booming, high-growth sectors. Historically, after the Fed begins to ease rates, REITs have consistently outpaced the broader stock market. We're talking about sectors with what we call secular demand, unstoppable trends that are growing no matter what. And that's where our focus is today. We're not just looking for any REIT, we're looking for best-in-class companies in the most explosive sectors. But one of these REIT sectors benefits far more from rate cuts than the others, and it's not the one most people expect. Our first REIT is an absolute giant, a company that forms the physical backbone of the digital world. I'm talking about Prologis, ticker symbol PLD. Prologis is the undisputed global leader in logistics real estate. They own and operate around 5,500 buildings, totaling over 1 billion square feet of warehouse space across 19 countries. So, why is Prologis a prime candidate right now? The e-commerce explosion, their dominant market position, and the direct impact of lower borrowing costs. The shift to online shopping is a permanent, multi-decade megatrend that has created an insatiable demand for modern logistics facilities. Prologis doesn't just participate in this market, they practically are the market. They have a wide moat, or a sustainable competitive advantage. It requires immense capital and expertise to compete at their scale, which gives them an unmatched advantage in serving the world's largest companies, from Amazon and Walmart to FedEx and UPS. Now let's connect this back to the Fed's rate cuts. For a company that's constantly developing and acquiring new properties, lower interest rates are a game changer. It dramatically reduces the cost of their growth projects, allowing them to expand their empire even faster. This next part is critical. Prologis currently offers a healthy dividend yield of around 3.15%. The company has shown incredible resilience, with core funds from operations, a key metric for REIT profitability, growing 4.2% year over year in its latest quarterly report. With occupancy rates holding strong at nearly 95%, they have stable, predictable cash flow. But here's the interesting part. Prologis is also becoming a sneaky player in the data center space. They've realized their massive industrial parks, with existing land and power access, are perfect spots for data centers and now have a significant pipeline of power secured for future development. This adds a whole new layer of growth on top of their dominant logistics business. For a new investor, Prologis is an ideal anchor. You're not just buying a real estate company, you're buying a piece of the critical infrastructure that powers global commerce. Now, if you want to get more analysis like this to help you build lasting wealth, do me one quick favor and hit that subscribe button and turn on notifications. It's free and it's the best way to make sure you don't miss the next big opportunity. Most people assume warehouses benefit most from rate cuts, but they're wrong. The next REIT benefits more by a wide margin. Now that we've covered the company that moves physical goods, let's talk about the one that moves the world's data. Our second pick is at the epicenter of the biggest technological revolution since the internet, artificial intelligence. This company is Equinix, ticker symbol EQIX. If Prologis is the landlord for e-commerce, Equinix is the landlord for the entire digital world, and especially for the AI boom. Here's why this matters right now. The reason Equinix is so compelling can be summed up in two letters: AI. Developing and running AI models requires an almost unimaginable amount of computing power in specialized industrial scale facilities. You need data centers. The demand for AI infrastructure is exploding and has turned data center space into some of the most valuable real estate on the planet. The data center sector was one of the top performing REIT categories in 2024, delivering a stunning 25.2% return, largely because of this AI-fueled demand. This number changes everything. Equinix has posted 87 consecutive quarters of revenue growth. In its most recent quarter, their adjusted funds from operations jumped 12% year over year, and they saw record bookings from companies scrambling to secure data center space. This isn't a company hoping for growth. It's a company trying to manage an avalanche of it. And this is where the Fed's rate cuts become so powerful for Equinix. Building data centers is incredibly expensive. As interest rates fall, the cost of financing Equinix's massive global expansion drops. This means their return on investment for each new data center gets even higher. For investors, Equinix represents a direct bet on the physical foundation of the AI revolution. You don't have to pick which AI software company will win. By owning Equinix, you're investing in the essential infrastructure that all of them need. It's like selling shovels during a gold rush. And what makes the final REIT so powerful is that it connects everything we've talked about so far. We've covered the infrastructure for physical goods and for digital data. Our third and final REIT is the essential glue that connects it all. It's a company whose assets you see every single day, but probably never think about as an investment. I'm talking about American Tower, ticker symbol AMT. American Tower is a global landlord for wireless carriers. They own and operate over 220,000 communication sites, mostly cell towers, across the globe. Major carriers like AT&T, Verizon, and T-Mobile rent space on these towers to provide coverage for our smartphones. It's an incredibly profitable model. So why is American Tower a top pick right now? The case rests on the relentless demand for mobile data and the ongoing global rollout of 5G. Here's the mistake most investors make. They think 5G is already old news. While 5G might feel common in the US, the deployment is still in its early stages in many of American Tower's international markets. The next phase involves densification, adding more antennas to handle ever-increasing data traffic. Every new antenna is a new lease for American Tower. Think about the trends we've discussed. The growth of AI in Equinix's data centers creates more data. The growth of e-commerce from Prologis' warehouses relies on mobile logistics. All of this needs to be transmitted wirelessly. From a financial perspective, American Tower is a model of stability. Their revenue comes from long-term leases with built-in annual price increases, providing a predictable stream of cash flow. They currently offer a dividend yield of around 3.8%. Recent reports show the company is seeing solid demand, with attributable AFFO per share growing approximately 10% year over year in the latest quarter. As interest rates fall, American Tower's reliable and growing dividend becomes even more attractive. Through its acquisition of CoreSite, the company also gained a solid foothold in the data center business, positioning them perfectly at the convergence of mobile and cloud computing. For an investor, American Tower is like owning a toll booth on the digital highway. So let's recap. We have three powerful REITs, each riding a massive wave of growth. Prologis, PLD, the e-commerce titan owning the warehouses that power the digital economy. Equinix, EQIX, the AI landlord, providing the homes for the servers that run the AI revolution. American Tower, AMT, the unseen connector, owning the cell towers that form the nervous system of our mobile world. These companies aren't just well positioned for falling interest rates, they are fundamentally essential businesses set to grow for years. However, no investment is without risk. A sharp economic slowdown could impact Prologis, high development costs are a hurdle for Equinix, and carrier consolidation could affect American Tower. It's important to do your own research. For those who feel picking individual stocks is too daunting, a diversified REIT ETF is a fantastic alternative that lets you own a piece of hundreds of REITs in a single investment. The important thing is this: the Federal Reserve's policy shift has opened a window of opportunity. And by the time most investors feel confident buying these, the best yields may already be gone. Imagine a few years from now, looking at your portfolio and seeing a steady stream of growing dividends. Income powered by every online order, every AI query, and every gigabyte of data flying through the air. Now, I want to hear from you. Which of these three REITs are you most excited about? Prologis, Equinix, or American Tower? Drop your thoughts in the comment section below. I read every single one. And finally, if you got value from this breakdown, make sure you're subscribed to the channel with notifications turned on. In the next video, I'm breaking down which REIT dividends are most at risk if rates reverse again. Thank you for watching, and I'll see you in the next video.